Okay, Anthony Molinaro, we're back. Okay, you had another good idea. So this one is like, I don't even know what you call this, but you had seen a presentation we had given and you wanted to ask stuff about it.
Yeah, steps to living life on your terms. Where do you start out? I don't think it matters what age you are either. You could be a young guy like me, or you could be, someone in their 40s or 50s that we see all the time coming into Rockstar, and they want, they know they want to get ahead. They want to use real estate to do that. They want real estate to be the vehicle, but they don't necessarily know where to start or don't have a framework for, what they should be investing their time into, and just a step-by-step process. It's just kind of like, oh, maybe I'll buy some properties and try to get ahead. But I feel like we could, you've laid
get some properties, and that'll be it.
And that's a great start.
Yeah.
You're taking action and getting somewhere, and using real estate to get ahead. But you've laid out a great step-by-step framework that I think would allow people to tackle this journey more intentionally. And I really like it. I'm personally using it for myself, so I thought we could talk about it.
Okay, so this is 6 steps that we've gathered over the years from different people and assembled together of things we've liked when we've heard from other people. Let's go through it.
Okay.
So the first step for us, and this won't be on the screen right now, but we'll go through these 6 steps, I think, pretty clearly. Step 1 is that the first priority should be getting your own place to live. We all need a place to sleep. So to us, that would be buying your own place and then eventually paying that off completely. And when you first buy, you're not going to be paying it off completely. But the reason that we believe you should own a home versus renting, and I know that can be up for debate and people will argue it, is that when the monetary system is set to reward assets instead of savings, most people, when they did their analysis, so in the early 2000s, there was a lot of analysis on renting versus owning. And the financial planners that did that analysis that was published in different Canadian media always concluded from, maybe it wasn't always, but whenever I read it, I felt like they always concluded that renting was better. That, you didn't have to pay for the air conditioner if it broke. You didn't have to pay for the roof repairs.
Really, renting was
better. That renting was always just better. You didn't have to pay for property taxes. And this would be in the years like we're going way back, 1997 to like 2007. Like that 10-year period, if you read the, when different financial planners in like the Toronto Star or something would say, hey, let's work on this person's portfolio, or the Financial Post or whatever it was, they would always conclude that renting was better. Anytime I read it, it felt like that. And I feel like the biggest thing they never took into account was the appreciation of the real estate. Mm-hmm. So on a purely expense basis, maybe renting was cheaper than buying, because if an air conditioner broke, you didn't have to pay for it. But they never took into consideration how much equity through appreciation was built into these properties. So if you bought a home, so for example, my first 4-bedroom home in Mississauga that we moved into, Carol and I, was $268,000. We bought in like 2002. It was a 4-bedroom home, two-car garage for $268,000. Mm-hmm. That house today, I think someone told me in that neighborhood, sold for like $1.6 million or something like that.
Yeah.
So
when we ran Toronto appreciation rates, I think it was back to the 70s, it was 6.5%.
Yeah, if you go all the way back.
That's to the 70s.
Yeah.
So you were operating off of that kind of data. When you bought a house.
Yeah.
Now it's ramped up even more.
It's ramped up even more. So, and I think none of these financial planners really took that into account when they did their rent versus owning kind of comparison. And people might argue today, well, it can't keep going like it has been going, so you should go back to renting. Like there's always this debate. But step 1 in life for us is, we've always believed, buy your own home, have a goal to one day pay it off so that you own it, so that if shit hits the fan in your life at some stage, you have a place to go sleep.
Okay. Now, can renting make sense for some people in some?
Yeah, I mean, we have some rockstar investors who are renting and buying their own property, but I just think at a stage in life, it's interesting. We had a rockstar member come in and say they were younger, they were renting and buying income properties, and that was the play for them because they were able to buy more properties, and I agreed. Mm-hmm. But now they're getting a bit older. They have a family. They have kids. And now they said all of a sudden their priority is to have like a home-based family home. So I think everything makes sense. Like everyone's life is unique. Like everything can, if you're going to live in Toronto for a few months, then go to Florida for a few months, then go to Europe for a few months, rent. Yeah. Like it's so case by case. But I do feel that at some stage in life, and I don't know when this exactly happens, it's probably different for everyone. I think to me it happened in my 30s where I was like, yeah, it feels good to say that's my house and I'm going to own it. I'm going to plan to own it and pay off the mortgage one day, and I'll have a home base for me and my family permanently. Mm-hmm. You know, when I look at some of my family in Europe, they don't have mortgages. And because they live in different villages outside of the cities, and these houses have been passed on for generations. And I just think it's a nice feeling.
Yeah.
Because they can just go home and sleep and not worry about paying for that house.
Mm-hmm. So it's financial freedom at a certain point.
Yeah. So to me, owning your own home is a big goal. And I think it just gives you security, peace of mind.
Yeah. So before we started recording, we were just talking about paying off that house versus maybe using some equity in it to buy more rental properties, and how, you know, your situation might be different. For example, myself as a young person, how I might want to use that equity to buy more rental properties just because of where I'm at in life. But for somebody else, maybe a bit older, who maybe has a rental portfolio, you're saying like, take it in, you know, like pay off the mortgage.
Yeah.
And you don't necessarily want to stretch yourself as thin or leverage up as much.
Yeah. It's kind of like stages of life, because when I was in my 20s and 30s, Nick and I were fully leveraged. So I bought my home. I got a credit line on that home. I used the money from the credit line to buy more rental property. Right? Like
and then used credit from those rental properties.
To buy more rental properties. Then go into when can we refinance the rental properties, get more credit?
Yeah.
And then I think you come to this stage, like we were just talking, I'm turning 49 this year.
Yeah.
And I think you come to a stage where you don't need to maximize anymore. You've spent 20 years of your life kind of leveraging, and now there comes a point where you want to have like maybe your family home with no mortgage. No credit lines on it. You just want to have it fully paid off. And I think the peace of mind that it gives me right now is huge, because I know the home base is taken care of. Mm-hmm. But that could be dependent, you know, if you're in your late 40s and you haven't built up other streams of income, maybe you are going to take a credit line on your home to buy some rental properties.
Yeah.
And I can't argue against that. I'm just saying there's a certain point in your financial life where you look at things and you don't need any more leverage. Leverage isn't like the thing for you anymore. Mm-hmm. You're like, okay, I have enough right here. I'm going to pay off the family home. Your rental properties, you can always leverage.
Yeah.
The interest is tax deductible. You can leverage those things up and do with them as you please. You know, but your
personal family home,
personal family home. I just think now in my late 40s, turning 50 soon, I just think, wow, isn't it nice to just have the family home with no mortgage on it? Like there's just a sense of peace.
But at 50, you're still leveraging your rental properties?
Yeah. Yeah. We haven't been as aggressively in the last few years, I think, because we've been busy with Rockstar. Yeah. Otherwise, we could have leveraged them to buy even more properties. But we are. Yes, like we have no goal to like pay off mortgages on our rental properties.
Yeah.
If anything, I think Nick and I just this weekend were saying, hey, should we refinance that one, pull some cash out, and and we're buying more rental properties. Nick bought one that closes this year. I want to buy 2 rental properties, ideally in Oakville somewhere this year. We're closing on a Blue Mountain property this year. Yeah. So, but for these properties, we have like no goal to pay off the mortgages.
Yeah.
But the family home, step 1, get a place to live and eventually pay it off.
Yeah. Okay. Step 2.
Step 2. What do I have here? Step 2. Oh yeah. Step 2 is getting skills or building your skills, but being very cognizant of what the marketplace is rewarding. So for example, like today, if you're building your skills in manufacturing in the Ontario area and we're not creating new manufacturing jobs, maybe that's an area where those skills are, I'm not saying they're not super valuable, mm-hmm. but in this economy right here, maybe they're not presenting you with a lot of opportunity. Whereas today, some of the trends that are kind of rolling forward might be online. You know, what's online? I'm going to come back to real estate. This area has been very rewarding for real estate for quite some time now. Can you get some of those skills? So like for myself, I had some friends who went into manufacturing jobs in the late 1990s and early 2000s when software was exploding. The information technology industry was exploding. So if we both entered the workforce, and some even with more education than me, like an engineering degree, and went into manufacturing at that point in Ontario, because Ontario did have a lot of more manufacturing than we do now. And I went into software. If software is trending, more money flows into it. The incomes are higher. The bonuses are higher. If you're in sales, the commissions are higher. So if you're selling even if you're selling some goods that aren't in a trending industry, you're just not getting rewarded at the same pace. So step 2 is analyze the economy, decide what you think is going to be trending for the next 10 years, and then build skills in those areas.
Yeah. Nick, I think at one point had a really good metaphor. And if there's a river of money, all you have to do is stick a bucket in to that river, and you can just get a little bit of that. And, you know, it's just makes sense as opposed to finding a trickling stream and trying to fill up your bucket from a trickling stream.
Yeah. Yeah. And another mentor of ours, Dan Kennedy, would always say, find out where the transactions in the economy are happening with or without you. Where are the most transactions happening with or without you? Mm-hmm. It's kind of why we picked real estate.
Yeah.
Because we were like, wait a second, there's always real estate transactions happening. People always, you need a place to live, and people are always selling and switching where they want to live.
Yeah.
So that was a river of transactions. Like we literally had that conversation. It's maybe where he kind of picked that up from. If those river of transactions are happening with or without Tom and Nick, why don't we just get into them?
Yeah,
put ourselves in the middle.
Tap into it.
Yeah. And if that's, if that river is happening, we could get a little spoon and kind of take some of that for ourselves selfishly, right? But for that, we needed to get our real estate licenses. We needed to understand business building skills and marketing. At first, we weren't building our own business. It was just how do we market ourselves? So we need to understand marketing at a very, very high level. So on step 2, when we talk about once you have a place to kind of live, what skills are you developing in the marketplace that reward? So for us, the best skills were marketing skills, because getting the real estate license was pretty easy. But how do we get some of the river of transactions guided our way? So the highest return for us was marketing skills. Mm-hmm. It wasn't understanding the 18th way to flip a property. Or how the BRRRR strategy is really popular. That's something we were doing 20 years ago. We just called it like buy, fix, and like flip or rent. Yeah. You know what I mean? And then refine. But someone puts an acronym in it, and then other people are like, well, I want to know the 25th way to make money in real estate. Well, once we understood the basic ways to make money in real estate, and our family, to be fair, had been in real estate for years, so maybe it was a bit easier for us, I don't know. But we quickly then shifted to saying the marketplace isn't rewarding that anymore. The marketplace isn't going to reward Anthony Molinaro if he knows how to flip a property 18 ways versus 15 ways. But if Anthony Molinaro knows how to get business coming his way, it's going to reward Anthony Molinaro. So at a certain point, you have to develop some skills in your area of expertise, but you would then have to focus on what is the marketplace rewarding. For us, it was sales skills and marketing skills.
But if I could flip the property 18 ways instead of 15 ways, doesn't that put me at an advantage over the guy who's only doing it 15 ways?
It does, but how much of an advantage? There's a diminishing return. Because after the second and third way to flip a property, how much more efficient are you at the 18th way?
Yeah.
Do you know what I mean? Like, I'm not saying not to understand the first 5 ways to flip property.
Yeah.
But some people will take it so deep that they know everything about real estate flipping properties, but they don't know how to find their next deal, which comes from marketing and sales and joint ventures.
Yeah. So get that base knowledge in one area and then get base knowledge in another area and then marry the two.
Correct. Yeah. You want to develop an expertise in one area. Absolutely. But you want to then recognize that once you have that expertise developed, you need to look how the economy is going to reward you. So if you understand 18 ways to flip a property, but you don't understand how to get your next deal through advertising yourself, through your sales skills in getting the next joint venture put together, how are you going to take advantage of that 18th way? So that's what I would call somebody who's book smart in real estate, but doesn't have any real world application of it. So sure, learn all 18 ways to flip a property. Mm-hmm. But Anthony, how are you getting your next joint venture? How are your presentation skills? How are your sales skills when you sit down with someone? I'm not talking about tricking someone to do a joint venture. How good are you at selling your idea to do the next flip with you or the next property? You need those skills.
Yeah.
That's the skills we're talking about.
Okay.
Right? So look at what the marketplace is rewarding and focus on building some skills. And then the next step 3, is while doing that, if you do have some savings, so if your skill development is nothing we just discussed, let's say I'm just going to get into the medical field and I really want to be a doctor or a nurse or a dentist or a dental hygienist or whatever it is, and that's your passion, you're going to chase it. Absolutely. And the marketplace is rewarding those. We need doctors and nurses and dental hygienists, right? Step 3 should be, if you're able to save some money, which ideally you should be able to, you then either want to buy other streams of income or build them. So you can be a nurse or a doctor or a dentist or a dental hygienist or whatever, but you then need to add in other income streams. That should come as a rental property or building a side business. And the reason for that, in our opinion, is that everyone gets frustrated in their career, or they get to my age and they get let go and don't know what to do. So you want to build other income streams around you when you have a lot of energy in your 20s and 30s, so that when you're in your late 40s, if you get cut off from that dream job in that corporation that you just loved working for, but you get the phone call and they cut you off, and I know many people who've received that phone call, you have other streams of income around you. So like step 1 is get a place to live. Step 2 is build skills that you want in the marketplace. Mm-hmm. And step 3 is you need other streams of income around you. Start building them now. Whereas I find a lot of people, they just take forever to build them. Most people get to my age in the late 40s and they're like, well, I guess I'll start a business now, or I'll become self-employed now, or now I guess I should buy a rental property. No, buy them in your 20s and your early 30s. Mm-hmm. It's difficult. It's hard. Do it then. That's definitely step 3.
Yeah.
Now I feel like I'm getting angry. And so, yeah, I think we can skip to step 4.
Yeah.
So step 4 would take some cash flow or equity from the business or real estate that you've started building, mm-hmm. and buy more. That's when that's when the leverage is easy. You're young.
Yeah.
You have time.
You have employment.
You have employment.
So the banks will let you.
The banks love you.
Yeah.
Leverage some of if you've been buying some rental properties, or if you've built a business, if it's around for a little bit, the banks will lend on the business. Mm-hmm. They'll lend easier with real estate as collateral. But that's when you want to take the cash flow and save it and buy more business or real estate, or tap into the equity, refinance the property, extract it out, and buy more property or expand your business. That's the next step. And usually when you buy real estate, you can't do that for a couple of years, and it's very frustrating, mm-hmm. because someone like yourself, you're young, you want to take over the world, and you're like, shit, I just bought a property and I can't do anything now, but I know 19 ways to flip a property, yeah. But I don't have the equity. I don't have the equity. So we always say there's like this 2-year window where everything sucks. You buy a property and everything's just horrible. Yeah. But then after 2 or 3 years, you usually have some equity, whether the mortgage is being paid down, or maybe it's the mortgage being paid down and you got some appreciation.
I just got through that kind of desert 2-year stretch, and I'm finally refinancing my personal.
And it felt great. No?
Yeah, it feels good.
Yeah. So that's the next step. And you keep building your assets. And you want to be careful with leverage. You don't want to over leverage yourself. Yeah. But real estate's really nice. We've talked about this, I think, briefly before. It's not marked to market. Mm-hmm. So it's not like the banks reevaluate it every day. So you get a mortgage, and then, the banks, as long as you're making the payments, as far as we've seen from the beginning of time, and this is right through the 1990s real estate correction, crash, if you're paying the mortgage, the banks just don't care. They don't care about the property prices. If the property price could be cut in half, and if you're making your mortgage payment, they don't care. They don't have time for you. So
what if you build up a portfolio, let's say you build up 10 properties, and then you retire. Let's say you're living off the cash flow from your properties. Mm-hmm. You don't have a T4 income anymore. Let's say you have no income, no mm-hmm. other side hustle, no business, mm-hmm. and your mortgage terms come due, like your 5-year mm-hmm. term or whatever. The banks will just let you keep carrying that mortgage on, even though you don't have income anymore.
Yeah, who knows what the banks are going to do going forward, but in the past, that's how it's been. Okay. If you're renewing a mortgage, the banks are not requalifying you for that mortgage. So if you had a 5-year term, they'll just roll it into a new mortgage. They're not asking for all your financials again.
Okay.
It kind of limits you in that you can't really shop around your mortgage, because if you can't qualify, you can't play the game of, hey, you better give me a better interest rate, bank A, because I'm going to go to bank B and get a better rate.
Yeah.
Because you can't qualify at bank B, right? But you can still threaten, and that's what we've done. We're like, hey, you know what? You better beat that rate, because we're going to go down the street and get another mortgage, and then they're usually like, okay, we'll give you a better rate.
Huh. Okay.
So we've done that over the years for sure.
Yeah.
But that you can't qualify at that moment. So
but you can still own millions of dollars worth of mortgages without having an income. So it's like
Yeah.
build that up while you have
Bill,
income.
when you have an income, just absolutely maximize it. Yeah.
Yeah.
But we meet many retired Canadians who don't have an income and then they can't buy income property, even though they might have a good financial net worth. They have, they might have some stocks and they might have a lot of equity in their homes, but they have no income. Banks, most people don't understand that banks are lending against your income. The real estate is just the collateral they're using as a safety net to get the mortgage back. The money that they lent you back.
Yeah.
But they're not lending on the real estate income. They're lending on you as a person.
Yeah, your income and your credit.
Yes, your income and your credit.
Yeah.
They're just using the real estate as the collateral on that lending.
Yeah.
Right?
Okay.
But yeah, so it would be to expand. And then step 5 is hold any savings not required, for your life in a harder form of money. So for us, that would be gold. And now it's Bitcoin. So once you decide like, okay, I can't really buy my next property right now because I can't qualify, but you're ideally still saving money. Mm-hmm. Don't hold that money in Canadian dollars because Canadian dollars is unsound. It's a broken system where they just print more money, so it devalues that currency. That's why most people think property prices are going up, or really the bricks and lumber didn't change. It's just the value of the dollar that's going down. You need more dollars to buy the properties. So don't hold any savings that you don't need, any money that you don't need for like 6 months. It's going to be different for everyone, right? Mm-hmm. Maybe 3 months, 6 months, 12 months, 18 months, whatever it is for you. Don't hold that in Canadian dollars. Hold that in harder currency. Harder money, true money. Mm-hmm. So for us, that used to be gold, but now it's definitely Bitcoin. Mm-hmm. And you need to do a lot of studying around that to feel comfortable with it. Some people are going to think that's super risky. I think the opposite. I think holding any savings in dollars is risky. But that's our next step. That once you're able to save up some money, never hold it in Canadian dollars. And some people will say, well, then I'm going to buy some stocks and stuff. But if I look at what happened in Turkey just recently, Turkey's a G20 country. So it's a big economy in the world. They just went through such bad inflation that they shut down their financial markets. So if you had $100,000 worth of stocks, you couldn't get to them because the president shut down the stock market.
Really?
Yes. So to me, you just want some of your money out of the system in a form of hard money. If you like gold, great. If you like Bitcoin, even better. Mm-hmm. But get some of that stuff in your life. It's out of the system. And if you're going to buy Bitcoin, don't buy it all through like an ETF that's like into the stock market. Own some Bitcoin directly yourself and custody it yourself. To me, you want some savings out of the system.
Because it's just insurance on the money system.
Yeah.
Yeah.
And have access to it that if shit hits the fan, everything's a probability in life, right? Canada's economy is really considered, we're a G7 economy. Even though I think the size of our economy is like 10th or 11th in the world right now, we're considered a G7 economy.
So
one of the
7.
One of the biggest economies in the world.
Okay.
But there's still a probability that shit can hit the fan. Mm-hmm. It's not zero.
Yeah.
So for anyone listening is thinking, well, Canada's always going to be fine. Okay. But are you giving it a zero probability to any crap hitting the fan in this country? Any credit market contagion that shuts down the banks? I'm not. So what's your percentage? Is it 10%, 20% chance of that happening over the next 10 years? Is it 50? Is it 80? Whatever it is should convince you to buy some money or own some money that is out of the system. The probability is not zero that there's not going to be a major credit problem in this country over my lifetime.
So whatever you think that probability is, whether it's 5%, 10%, make that the percentage of hard money that you own in your portfolio. Like if your net worth is $1 million and your percentage is 10% probability, then do you own 10%, like 100
It's
grand?
so different. I mean, it depends. Like how steady is your income? How many cash flow streams do you have? How much savings do you have? Like it's so different for everyone.
Okay.
I would say just do it to your comfort level, right? So like I believe that the probability of a credit event happening in Canada in my lifetime is super high, like super high. So I want to buy as much Bitcoin as I possibly can that I don't need with cash that I don't need for operating my life, the business that I don't need to close on the next property for, right? All the other money I'm shoving into.
You're still buying properties. Yeah.
Yes. Yeah, absolutely.
Yeah.
But after that, I'm just shoving it into kind of Bitcoin.
Yeah. And it's a great way just to save small amounts of income.
Yeah. But you also need the education around it because some people are going to look at the price and say, well, that's too volatile. Like you hear a lot of the economists that are in like different universities say, I'm never going to buy a Bitcoin, or people will not buy Bitcoin because it's too volatile. And I'm just like, well, it's a brand new monetary class. Of course it's volatile. Like gold was volatile. I'm sure when someone minted the first gold coin in Rome, it was pretty volatile. Or the Medici family in Florence, when they made the first florin, I'm sure someone didn't exchange that gold for like 3 cows one day. I'm very positive that gold coin was exchanged for 3 cows one day, and the next day for 10, and the following day for 7. Yeah. On the cow index, that's pretty freaking volatile. Yeah. Over 3 days, it went from 3 to 10 to 7 because it was new. It was newly minted, and people didn't know how to value it.
You're trying to price the asset.
You're trying to price. It takes decades and hundreds of years for things to get stable.
And millions of individual decisions for buying and selling to kind of come to that one price. Yeah.
So for Bitcoin, it's never going to go like in this perfect linear line. It's going to be volatile, and likely going to be volatile for the next 10 years. The volatility will likely get less and less and less, but it's going to be way more than, US dollars or Canadian dollars.
Yeah.
Right.
Which are short term, not volatile, but long term just lose
value. Yeah. Yeah. Okay. And then the last step 6, look for your personal big opportunity and go after it with everything you've got. So like for me, from the age of 25 to like 33, when I quit my job, that's when my eyes were open for what is going to be my opportunity. And I started an online business. I think I was trading stock options. I thought that was going to be my big opportunity. I had multiple different online businesses. I had a coupon business called salesinthecity.com. I don't even own the URL anymore.
And each one you thought was your big opportunity?
Yeah, like I thought, okay, this is going to be like, I'm going to start the salesinthecity.com. My wife's going to send out the coupons in an email every day. We were just going to collect all the sales going on in Toronto. Mm-hmm. It was essentially Groupon that went public for like $1 billion before Groupon. And I wasn't ready to grow it into a business, but it was going viral. We were getting email addresses, and I'm like, oh my gosh, I'm going to turn this into like a very sizable business. And then about a year into running it, Carol and I just hated it. And we're like, well, this business sucks. We're not making any money from it yet. We stopped it. But I learned a lot from that. I learned email marketing. I learned how to send weekly emails. I learned the pain of that, but I also learned the value of connecting with an audience and offering them what they want. I learned that once you get into different media, you get exposure and your stuff can go viral. So I learned a lot, even though that didn't go anywhere. And then my eyes were peeled for what is going to be my opportunity. And ultimately it became real estate for reasons we discussed earlier.
Yeah. Did you find that opportunity though, or did you make it?
Which one? The real estate one?
Real estate.
We made
Rockstar,
it.
You made it.
Yeah. But I guess I decided that like there was these transactions happening, and that was my big opportunity, was to get some of those transactions that were happening in real estate with or without me. Whereas earlier, the big opportunity was, what new business idea am I going to come up with?
The opportunity was there. You just tapped into it.
Yeah.
It was already there.
It was already
happening.
It was happening from day one in front of my eyes. I just wasn't ready for it.
Huh.
Yeah. But when I was younger, it was like, I'm going to make a business of something. And, then I realized why that's hard, because I'm starting a new business in an area where maybe people don't even know they need what I'm selling.
Yeah. You're trying to like irrigate your own river of money.
Yeah.
As opposed to just finding it.
Yeah.
And then jumping in.
And making it what I want. Like Rockstar is very much a business the way Nick and I want it. Yeah. Like we're a brokerage, but we don't even like admitting we're a brokerage. We feel like we're more about education and like living life on your terms, and teaching people it is possible to live the life you want and design the life that you want. And by the way, we happen to be a real estate brokerage, right? Yeah. So you can make it whatever you want, but have your eyes peeled for your big opportunity, because you never know when it's going to come. And you never know when you're going to have to just get frustrated enough like I did and make it for yourself.
Does someone necessarily need a big opportunity if they like what they're doing?
No. Yeah, that's a good point. I think my personality type needed it.
Yeah.
Yeah, I needed it. But yeah, like if you're building off properties and you're saving in Bitcoin and you have a career that you love, you likely just can carry forward with that and kill it. Because your big opportunity, to be fair, was if you're getting some investment properties, you realized, assets are winning in this monetary.
Just buying some rental properties, that's a big opportunity.
Yeah, like any Rockstar members we've worked with in the last 10 years, the big opportunity has been buying real estate. Like that has been their big opportunity. We have many people with portfolios that have millions of dollars in equity that have formed over the last 10 years. Mm-hmm. That has been their big opportunity. So you're right. You don't have to like quit your job and start your own business for your big opportunity. I know many people who have careers that get great incomes, But then on the side, they have different properties and different things operating. They have multiple streams of income happening, and it's great. Should anything happen to their career, they're good.
Yeah, they're covered.
So yeah. So anyway, those are 6 steps that we like to think about sometimes. And I can't even tell you where we've picked them all up over the years, but it's been a combination of kind of different mentors over the years, different books we've read. But those are 6 steps.
Yeah, for me, it's useful. The first time I saw this, I don't know if I wrote the steps down or I just looked at the slides and I was like, all right, where am I at in these 6 steps? And, just aim at the next step. Just try to get to the next one. So it's really helpful having this framework.
Cool. Thanks, Anthony. Good chat.
For sure.